Energy is now teetering on going negative for the decade, basically flat since December 31st of 2009. Case in point, ExxonMobil's fall from grace over the past 10 years, from the most valuable stock in the S&P 500 by market cap to number 13 as tech has really taken over and dominated the large cap index. Now, during that time, West Texas Intermediate crude oil, U.S. benchmarks, down nearly 25% as global production has more than doubled, according to the EIA. So can the sector actually stage a turnaround in 2020 and beyond? Joining me now is Mizuho Managing Director Paul Sankey. Paul, this is your game. You watch oil. You watch energy companies. Can the energy sector turn things around and become a bull scenario for investors in 2020?
No. I mean, the problem here is...
That's tough.
No, in all seriousness, the problem here is there's three major overhangs on the sector as far as investors are concerned. There's what we call the end of the peak oil age effect, which, as you said, is essentially driven by the U.S. revolution we had in supply. There's the Tesla effect. And there's the Greta effect. The third effect is a sort of environmental, social governance.
It's also softer, right? It's more kind of a sentiment-y type-based system.
Now, I was being facetious when I said no, because actually I think the answer is yes. But the fact is that those three things will remain an overhang. And you're not going to shift that idea that Tesla's coming. Now, Tesla was expected in 2009, back when your graphic started. It's actually the Tesla effect, I should say. It's actually just not showed up at all. But it will continue to remain an overhang. Now, if we go back to the specifics of 2020, the market looks a lot better, certainly than it did 6 months ago when we modeled it forward. Basically, demand, we haven't changed our demand numbers, but demand is expected to be pretty robust after a somewhat weak 2019. And on the supply side, combined with OPEC cuts, which may or may not happen, we do have an initial surge of production growth. But then in the second half, things actually look balanced, finally.
All right, so balance is the word I hear tossed around a lot about oil prices and the markets overall. Supply and demand, balanced prices. What's driving more of that? Is it the demand side of things? Is it a pickup possibly in 2020 from not just us, but the emerging markets? Or is it the fact that OPEC, OPEC plus, ROPEC, OPEC and friends, whatever you want to call them, have they actually done enough to balance out and cut supplies to balance that market? Or like you said, are they going to cheat and just kind of put more oil back on the market?
That is the question. I think it's one of those self-defeating situations, whereas when oil is up here at 60 WTI, just about, OPEC is less incentivized to cut. It has a knock-on effect because essentially if the cheating members of OPEC don't cut, then Saudi's not going to cut. So there's actually a scenario which is that you get back to a market share war within OPEC in 2020. That could definitely be the case. But further to your question, I think the big risk actually on 2020 is demand. That is where the bears will tell you they're bearish and where the bulls will tell you they're bullish. Depending on whether you put in 800,000 barrels a day of demand growth or 1.2 million is really the difference between the market being balanced and really quite badly oversupplied. And at the moment, we're modeling, let's say, 1.2 million. That's a significant acceleration from 19 and could be at risk.
So does that mean then, as we talk about the companies, the people involved, the industries for oil and gas, specifically in the United States, is there any kind of a real bullish case to be in those types of companies? And if so, which ones benefit more, relatively speaking, in a more balanced oil environment? Is it the big integrated majors? Is it just kind of boutique oil and gas shale plays in certain parts of the country? Is it focusing more on natural gas? I mean, what exactly would that trade be in 2020?
Well, a few years ago now, 3-4 years ago, we realized that the Permian and the U.S. opportunity is really the best industrial opportunity this group has had in 50 years. And the question was, why does the market hate this group, this E&P group particularly, when they've got such an outstanding industrial opportunity? When you've got this boom in U.S. oil supply growth, it should be good for the companies. Everybody hates them. And so what's the problem? At the same time, the oil price is not bad. I mean, it's $50, $60 a barrel. And the answer was the problem is the companies. Their strategies suck, and they need to get into a position where they're actually generating cash return to shareholders, essentially paying people to own the stocks because of those three effects that I talked about. So the long-term secular outlook for oil looks challenged to the market from the point of view of Tesla, Greta, all the other issues we talked about. But now what they need to do is improve their strategy and essentially think about more of a tobacco model where you bribe people to own the stocks and they become attractive on that basis.
Really quickly, just a couple of moments left here. What's your favorite play? What's your favorite name in the space then?
The best company is EOG. Whether or not they're getting their cash return strategy right, we're less certain, but we think over the long term they'll get it right simply because they're the best.